Hello, everyone. Welcome to another episode of the Truth About Real Estate Investing show. My name is Erwin Cito, and I'm wondering, what did you do for April break, formerly known as March break? Probably not much, because we're not allowed to go anywhere. But I don't complain that much. I'm still able to golf. I'm still able to go outdoors. I was able to open my pool. Uh, yeah, for us, we've made as many plans as possible to stay around the home, since we can't go anywhere anyways. We planned in advance by buying the kids new bikes just a few months ago as a reward for doing so good at school. And better yet, it was paid for their grandfather. This past weekend, we opened up the pool, and it's rained ever since. I think we have maybe one nice afternoon of weather, but the pool still wasn't warm enough. Opening the pool is time consuming, but my kids were enjoying hanging out with me poolside while I work on it, checking out the pool chemistry, watching. I watched a lot of YouTube videos to learn how to work a control panel and a heater. Also operating our brand new pool scrubbing robot. The robot in automation is something that I wanted to highlight for my kids, as it's a common lesson that I've come across in my journey, interviewing people on the show, for example, and working with investor clients. Some were taught by their parents that one must work hard to achieve anything. If you want to get ahead in life, you have to work hard. While that is largely true, I believe one must separate hard work using one's hands versus what can be outsourced or delegated so that one may focus on higher value activities. In the example of my pool scrubbing robot that the kids have assigned a name, Zobi, that's the name of the robot, Zobi. Zobi will vacuum the pool and scrub it without supervision for a couple hours on a timer, so I don't have to scrub and vacuum the pool myself, which will save me more time to do important stuff like hang it with the kids, ride on my indoor Peloton bike, work on the business, record these podcasts, etc. It's no different in my real estate business. I don't get my hands that dirty. I don't unclog toilets, mow lawns, shovel snow. I will if I absolutely have to, but generally, actually, I still do pick up garbage whenever I visit properties. During my 6-month inspections, I want my property managers to know that I care, and I'm willing to do what has to be done in order to operate a quality investment property. And even this past week, I had to take our family minivan to take it to a property, which was our home, the property that I listed and sold. It was the day of closing, and there was still some extra garbage that the garbage folks didn't take away, which was fine. That was our fault. But I wanted to take it away. I filled up the garbage, the minivan full of garbage. It stunk. I took it to the dump. And then the funny thing was that it was late in the day, so the dump was already closed. So I had to leave the garbage in the trunk overnight. It was cool. It was a cool night, so I thought it wouldn't be too bad. But in the morning, the kids got in the car. This is before our April break. The kids got in the car and they're like, "It stinks in here." I'm like, "Yep, I had to take trash to the dump." That's what it's like to be a hustler sometimes. But anyways, my point is that I'll get my hands dirty. It was the day of closing, so I didn't want that garbage to be left behind for the new homeowners. That wasn't the impression I wanted to give them. But the rest of the time, my team operates my investment properties for me, including architectural drawings, plumbers, carpenters, fence folks. My team gets my permits, they do my renovations, and of course the ongoing management of the property and the tenants. If you're like me and want to be invested in the number one asset, the plan is that we will buy another property probably within the next 12 months in an area of high demand by both tenants and by home buyers. Then you want to be on my email newsletter. It's completely free. You'll be informed of our free online real estate training classes, our free online top investment city and property tours, and my favorite, the IWIN meetings, where you can connect with local like-minded investors and learn from experts from my team and our guest speakers. Our next IWIN meeting is Saturday morning, May 15th, where real estate accountant Cherry Chan, CA, CPA of Real Estate Tax Tips, will be sharing about the Smith maneuver and how to do it properly. As many don't get this right. We did this wrong for quite some time as well, until Cherry learned how to do it properly. The Smith maneuver is a tax minimization strategy of making the interest monies that you pay on your home. So, most of us pay interest. Most of us have mortgages on our home, and you can actually make some of that interest to be deductible if you do it correctly when investing on real estate and investing in other things as well. So you don't want to miss this presentation, as again, many folks don't execute the Smith maneuver properly. Cherry would know. She sees a lot of people's tax returns, so folks are not deducting as much as they can, or they're getting in trouble with the CRA. Neither is a good thing, so you don't want to miss this presentation. Go to www.truthaboutrealestateinvesting.ca. I'll slow down. www.truthaboutrealestateinvesting.ca. Enter your name and email address on the right, and you'll be informed about when we host all these great events. IWIN meetings are publicly available, and they cost a mere $20 for non-clients. If you're clients, you come for these for free, and all the monies are donated to charity. Win, win, win. You learn, you meet awesome, great people, and the cost to attend supports local kids in Hamilton getting shoes and warm clothing. What more can you ask for? On to this week's show. This week we have real estate investor, influencer, multifamily apartment building investor, Seth Ferguson. Seth shares lessons and an update from his nightmare joint venture. Seth is returning to the show. If you haven't heard Seth's story about his joint venture partnership before, I would recommend you have a listen to that past episode. Yeah, and he shares about today. He shares about his journey from being a small local residential investor in mainly in Milton, Ontario. Now he's moved on to being an investor in apartment buildings in the 150 unit range. That's how many units are in each of these buildings in the U.S., mostly in the southern U.S., in the more landlord friendly legislated states in the U.S. The structure of these types of deals. So Seth explains the structure of these types of deals. These are called private equity investments, and how passive investors may participate. And I just understand, folks, Seth's giving me nothing for this show. I just like folks to know that these opportunities are out there in case you want to invest or you want to start one of these yourself. I just want folks to be aware of these things and be empowered and have knowledge that these types of investments are available for yourselves to start yourself or to invest in passively. So Seth also shares the motivations. So Seth agrees as well. He thinks the same. He's here to share his motivations for hosting a multifamily investor conference in May of 2022. And you can find details of that conference at multifamilyconference.ca. And Seth was kind enough to give us a discount code of IWIN. Multifamilyconference.ca, discount code IWIN. To my friends, enjoy the show. Seth, what's keeping you busy these days?
Oh, everything. Lockdown. I'm sick of it.
Yeah, who isn't?
Yeah, but lots of stuff is busy. I've got my little guy who's 4, full of energy now, which is amazing. And lots of things on the plate. You know, we've got the multifamily conference coming up. That's May 14th and 15th, 2022 in Toronto. So super pumped about that, and I'm sure we'll get into that. I'm actually launching the beta version of my multifamily investing course next week. So working hard doing that too, and just having conversations with investors like every week.
Awesome.
They'll find me on YouTube or from the podcast, and they'll reach out and just growing the database and the investor base.
Awesome. Yeah, I sent you someone last week.
Yeah.
And it's funny how that lined up.
Yeah.
Like, do you know anyone investing in the States? Like, I think he asked specifically for Florida.
Yeah,
so I sent him over to you.
Yeah. Yeah. And, there's, I'm just with YouTube and the pod, like, you find the same thing with your podcast. I'm sure, like, people will reach out and they're really interested. They're just looking for more information. So that's my calendar during the week. Investor calls, calls with brokers, reviewing deals and doing the underwriting. So it's fun.
Nice. Okay. A lot to cover today. Okay. So I want to start off with an update since last time you were on.
Yeah.
When was the last time you were here?
It feels like it was just a month ago, but it's been way longer.
Was it summer last year that you were here?
I was in shorts, I think. So that could have been any time.
You're in shorts today and it's 15 degrees out.
Yeah.
We're so Canadian.
I am. As soon as the snow's gone, I'm in sandals and shorts. Yeah, it was probably last summer. It feels like I was just here when I walked in. Yeah,
that's crazy.
Yeah, but an update.
So just to, in case anyone didn't listen to that episode, because we used to, I think we had 6 listeners at the time when you were on the show. We've since increased that to about 18. So more than 50% haven't listened to that episode.
Yeah.
So just quick synopsis. I think the show title, and that you approved the show title. Yeah. The show title was "The Worst Joint Venture Divorce I've Ever Seen."
Yeah, it was bad news. So I guess like Cole's Notes version, I had hooked up with this one person. We had built a single family portfolio. She went crazy, wiped out the bank accounts.
Right. His mental health. She wasn't.
Yeah,
Yeah.
yeah. And so a whole bunch of bad stuff happened. I lost a whole bunch of stuff. I don't even have golf clubs. So when you asked me if I wanted to go to the driving range, I was like, hey, I don't even have golf clubs yet. I have to buy some new ones.
Yeah.
So update.
You have money?
Well, yeah, there's still a decent amount of money like locked up in trust, and I was counting. It's been like 975 days, and it's still going on. She's on her 5th or 6th lawyer now.
Someone took her on. I'm surprised people even took her on.
Well, the thing is, like, not to say too much, but like, whenever, let's say you get fired by your last lawyer and you have to
red flags, right?
Yeah. But it's all depends on the story that the person tells the new lawyer. Like, it's like, those tenants who go around and screw everybody. They'll still find a new landlord.
Yeah, and they'll tell them a different story.
Yeah, unless you know somebody and somebody's told you. Yeah. So yeah, still trying to get a chunk of money out, but it will happen eventually.
Wow.
Yeah.
Okay, so it's in trust. So the money's with the courts?
No, it's in a lawyer's trust account, just sitting there.
Okay.
So it's the proceeds from a bunch of the sales we had from the single family portfolio.
Right.
So
but they're all sold?
Oh yeah. So luckily, like, that's all done, and that's been done for a while. It's just a matter of accessing those funds, and then just trying to get back the money she stole and all that stuff. So it will probably end up in trial at some point. So yeah.
How much does trial cost?
Oh, it can be quite expensive. Probably like 40-50 grand. Yeah, if not more. Like, I've never been through a trial, so I don't know.
Right. I've heard bad things about. For anyone who doesn't know, go look it up. And that's why, like, prenups are important. Prenuptial agreements are important.
Huge. Yeah.
JV agreements are important. Actually, I remember you shared a nugget the last time you were here about what was missing in your JV agreement.
Oh, well,
if we could at least share that one nugget, I think that'd be really helpful for everybody.
What was missing was the agreement itself. We had nothing on paper.
Oh, good.
Right? Because you're in love, like, you're together, everything's great.
Yeah. You have a kid together, you think you think you're going to be together forever.
Yeah. So that was the least of my worries. But it should have been. So now that the problem is, we did all these joint ventures together, but now with the most recent lawyer, they're saying, well, wait, these weren't joint ventures, and we weren't, like, so the story's being twisted because a lot of, there were renovations done on our principal residence, but we were both living there and working on it. But now they're trying to say, like, oh, well, the 250 grand into the renovations was just in you because it was in your name only and stuff like that. It's like, no, like, this was...
Wait, matrimonial home. Oh, gee.
Well, yeah. So it gets complicated, but
right.
So it's just a matter of, like, untwisting the details with what they're trying to twist. But with each lawyer, it's a different story.
Yeah.
So it is what it is.
It's not easy because I know what you mean. My experience with lawyers is they will not go by the letter of the law, and they will go say other things.
Oh yeah.
In order to try to do better for their client, even though those aren't the rules.
No, but you know what though, like, the lawyers are only as good as what their client tells them, right? Because everybody has a bias or a spin. So what I found with the past lawyers is once they actually figured out what really happened, they actually moved to settle things right away. But then that's when she hops to a different lawyer. So each lawyer, like, you're starting back from square one. They get the story from her.
Right.
Once they get all the details and they start getting the bigger picture, like, oh, okay, well, let's just do this.
Right.
But then she moves on to the next one.
Or she gets fired.
Yeah, which does happen.
Right.
So
for folks who don't know what we're talking about, please go back and listen to Seth's when he was previously on the show, which about a year ago. And then you'll get a better picture of what we're talking about. And the biggest nugget is have a joint venture agreement. And we're not lawyer bashing. There's lots of good ones. There are some bad ones. Like Seth and I both have our real estate licenses. there's lots of bad real estate agents too.
There's
Lots of good ones. There's a lot of bad ones too.
Yeah.
No different than real estate investors.
Yeah.
There's lots of bad ones. There's lots of good ones. So there's no industry is perfect. No industry is completely perfect devoid of people that aren't good at their job. But
yeah, but if you're going to buy a property with somebody, make sure everybody's roles are on paper so there's no misunderstanding. Because if you and I have this conversation now when we talk about doing some sort of joint venture together, even though we both had the same conversation, we may extrapolate something differently, or a meaning of a word might be different. So it's just good to have everything on paper, and that way, in the event you have a 1% chance of having a worst case scenario, if that does happen, at least you're covered, and you have records of the agreements and all that stuff. So,
and your son's okay in all this?
Oh, he's happy. We were out at the park yesterday, riding his bike. So nice weather. He's good.
And then, okay, so where are your golf clubs physically?
I'm not sure.
They're in a lake.
Yeah, I'm not sure where my passport ended. Obviously, I had to get new passports, but I'm not sure where my birth certificate ended. My all that stuff. I'm sure it just got trashed, because I was never able. Once the locks changed on the house, I never got back into my house. So all my paper, all my important paper, I was writing 2 books too. And I had years and years of research, and all those files gone. So I was crushed. Everything was gone. Wow. Yeah.
That's crazy. Okay.
Yeah. But anyway, so happy stuff. So my son's really good. He's really excited. So yeah.
Yeah. We're hitting the range today. We're hitting the range?
We are. Yes.
All right. Yeah. You're not one of those freaks that hit left-handed.
No, that's what you asked me. No. So hopefully your clubs are as good for you as they are for me.
Oh no, they'll hopefully no, they're awful. No. But, they're awful. That's me. It's me. Yeah. It's not the clubs.
I used to golf all the time, and then as soon as the craziness happened, obviously my clubs disappeared. So I haven't even swung a golf club in 3.5 years.
Okay, you'll probably still beat me.
No, I'll suck.
I'm pretty awful. All right. So I want to talk also about investing in the U.S.
Yes.
So you did well with your investments. That's actually one of the nice things about being a real estate investor. And unfortunately, things ended the way they did in quote unquote divorce. I don't know what you would call it. Yeah. But at least you're both walking away with money.
Yeah. That's one of the things that as soon as you start acquiring real estate, you'll realize that you make more money with the assets you own than the 9-to-5 job you're working or whatever you're doing to earn income. So that was a big. As soon as I realized, whoa, I'm making so much money here with the real estate I'm holding, it just changes how you look at it, and then you start adopting that. I guess you could call it the cash flow, Robert Kiyosaki, the cash flow quadrant, where you're always trying to be in the investor side of it, the business owner and the investor side. So it can be quite powerful.
So even though you were a successful investor here, your properties were in Milton, were they?
Yeah, so we had one in Brantford, then we had Milton. So yeah.
So you were having success.
Yeah.
But you decided to go south of the border.
Yeah, well.
What are you thinking?
So here's the thing. When my son was born, I can't remember if we talked about this last time. But anyway,
don't worry. Most people didn't listen to it.
Yeah. So when my son was born, we had the single family portfolio, and I just, you're holding your kid for the first time. You have that instant urge to do better and be better, not for yourself anymore, but for your kids. I'm sure you had the same thing with your kids.
They make me crazy.
Yeah. So I knew I'd made a lot of money owning the real estate, and I just needed to know how I could scale, right? So, but this is what I knew. Even though I was earning good income, qualifying for residential properties was tough. Once you don't fit inside the bank's box anymore, so that makes it challenging. The cash flow yield with a single family makes it challenging, and then the property management side also. Managing hiring a residential property manager, you're paying 10 to 12%, so that can make it expensive. So I knew real estate was the vehicle. I just came to the realization that, for me to scale to the level I wanted to scale to, like I want, my goal eventually is to control $1 billion of real estate. That's my goal.
Hmm.
I could not do that owning 1,000 houses. I worked it
It'd
out.
be hard.
Yeah. Can you imagine owning 1,000 houses with
Right.
like 1,000 tax bills, like 1,000 tenants? That would be nuts.
And just the financing alone changes
Oh,
your
for
commercial
sure.
financing, so that it really hurts the cash flow.
Yeah,
Then.
100%.
Yeah.
So I knew real estate was the right vehicle, but the asset I'd chosen was wrong. Well, not wrong. Okay, I shouldn't say wrong, because when I
You can't
started,
scale.
yeah,
You can't 1,000x.
yeah, and the thing is, like, the thing I wish most of, for anybody starting out, think about where you want to be in 10 years. Because if I would have done that when I first started buying the single family homes, I probably would have realized a whole lot sooner that that wasn't the right asset for me, and I would have made the switch. But I was never thinking about the future, what I was building towards. I was just randomly buying properties. So I had this one guest on my podcast. His goal is to run his portfolio from a pub in Ireland. So all the power to him. But the decisions he's going to make, the structures he's going to use, the people he's going to bring on his team are going to be different because that's his goal. Like, he wants to be remote, drinking his Guinness every year. So, but he has that vision in mind. And so that's going to guide everything he does. I didn't have any sort of vision like that. So I was very haphazard in how I went about it. Now, obviously, when you're first getting into real estate investing, you don't have any experience to base it on. But I think as soon as you acquire your first couple properties, you should start thinking about, okay, well, in 10 years, I want my life to look like this. So do I keep going with what I'm doing? Do I have to change slightly? What kind of property should I be looking at? What's going to get me to that 10-year goal? I call it my decade vision. And I think that that's really helpful to anybody just starting out building a portfolio. Yeah.
And then, but you started looking local.
Yes.
Or did you actually buy anything local apartment buildings?
No. The one thing, like, I'm a big proponent of the value add strategy. So you're finding, and if somebody's listening and they don't know what it is, you're looking for an asset that's either it's underutilized, so under market rents, it's poorly managed, needs renovations. There's additional income streams that can be added, that sort of thing. So really, you're looking to acquire an underperforming asset, improve it over your hold period, and then sell eventually, and earn and get all your returns. Here in Ontario, the landlord-tenant laws make it very challenging to buy an underperforming asset, do the renovations, and really force that appreciation and boost up the NOI on the property. You're really handicapped. And that's why I started looking south of the border. So I got involved with a couple people there and started learning the ropes.
Did you how fast did you just make the decision for the States versus rest of Canada? Did you even look at the rest of Canada?
Yeah, so before the atomic bomb happened in my life, I was actually looking out in Alberta. So before we started recording, we were talking about that. So I was looking at, like 15-unit buildings, like smaller things, because I had the thinking then, as I was, the same thinking I had building the residential portfolio, you have to do everything yourself. So, I had to use my own money to acquire the next property, or I had to refinance the property we owned to acquire the next one. I never thought about joint ventures and how you can use it to scale. I never thought about having other investors come on with their capital. That wasn't even on my radar. So when I was looking at these 15-unit buildings out in Alberta, it's like, okay, well, this is what I can afford with the capital I have right now. The syndication model or the real estate fund model wasn't even in my head. So I didn't know that was an option. Or I guess I knew it was an option, but I didn't realize how powerful it could be. And how many people out there have capital. They want to take advantage of all the benefits real estate has, but they don't have the time, they don't have the resources, they don't have the expertise.
Like I told you before we were recording, I'm listening to Steve Jobs' book. And his whole thing was trying to make everything simple and user-friendly. And I always try to tie that back to real estate. And like you said, like syndications or like REITs and stuff like that, they're popular because you just sign papers and transfer money and then you're invested. Like there's a market for people who want easy.
Oh, there is.
You don't want to do your work.
That's right. And one of the thing that blew my mind the most once I started getting immersed in the world of the commercial real estate is how much money is out there looking for deals.
Yeah, tons of money.
Unreal.
Yeah.
There's so much money out there, and it just. But before, I was just, I was selling houses and I started buying houses. I had no idea about this world, and there's a reason for it. Like the system's kind of rigged, and the banks and Wall Street want you to fit inside their box.
Yeah.
And the best real estate investments are hidden from the general public because of the securities laws.
Yeah, it's tough to find.
So they can't be advertised. So if you're just a regular person, you will never know what's going on under the surface.
Right.
Yeah.
So I actually, about a month ago at one of my meetups, I asked the question, what does the government want you to invest in? Like if you aggregate all the information you receive from the government, what would they like to ask? What you would like you to invest in? You don't have to answer that now, but think about it. We can come back to that later. But I want to come back to so you kind of make several leaps, in your investing journey. You went across the border.
Yep.
You met up with some new friends.
Yep.
And we're talking about syndication as well.
Yes.
So we're talking about different funding model, different market. New business partners.
Yes.
Okay. Where should we start?
Well, let's start with do you want to start with the model?
Sure.
The
Yeah.
syndication model?
Because it's an interesting model because I don't know many people that do it that way.
No.
Yeah. Please explain the model.
Yeah. So the syndication model is really geared towards raising large amounts of capital efficiently and placing it and having that the syndication acquire an asset. So
sorry, can you give an example of how much money we're talking about? Is it 50 grand, 100 grand, 2 million?
Yeah, well, actually, it might make more sense to start from the top down.
Okay.
So a syndication basically has two sides. So you have a limited partnership and a general partnership.
Oh, and sorry, just to clarify, we're talking about specifically to what Seth's doing. Syndication can be two people on a second mortgage on one house.
Oh yeah.
Right. It's a very general term.
Yeah, I'm glad you brought that up because a lot of people, when they first get started learning about syndication, think, oh well, this is a syndicated mortgage.
Yeah, no.
Totally different. So when I speak about real estate syndication, we're really talking about equity and ownership rather than having a bunch of people get together and placing debt on a property. Very different. The risks are very different.
Yeah.
The tax benefits are night and day. Yeah. So what happens is, let's say, Erwin, you are an investor and you have $200,000 and you want to scale up, take advantage of the better stability with apartments, the better expense ratios, more cash flow, and then the tax benefits with cost segregation and all that stuff.
So diversification. Yeah.
But with your $200,000, you can't do a deal on your own, right? You just don't have enough money.
It's a heck of a lot of work.
Yeah, and there's something I created called the real estate matrix. So there's 4 components every real estate deal has to have, right? You need the deal itself, you need the capital, you need financing, and you need management, somebody to manage the deal. Without one of those 4 things, the deal can't happen. So you as the investor with 200 grand, you've got some capital, but you don't have the deal, you don't have the management, you don't have the financing because you're doing what you do best day to day, putting bread on the table. What a syndication allows that investor to do is pool your resources with other investors like you. So there may be 100 people or 50 people or 20 people with 200 grand each. And now you're able to pool that capital. And then a general partner is somebody with the track record, the resources, the deal. They're coming with the other 3 pieces that the deal needs, and they're able to place that capital in a deal. So the syndication itself will acquire an asset, and you have ownership, you have equity, which is different from a REIT or a REIT, where basically you own a stock in a company that happens to own real estate. With the syndication, you actually have ownership in the real estate itself.
Right. Sorry, and when you say the real estate itself, is that for one building?
Yeah.
Or is that like 3, like when you I don't know how if you guys like buy like 3 buildings together or
Yeah. So if it's a syndication is on a deal by deal basis, so
right,
property by property.
right.
So let's say you and I we find a 150 unit apartment
Yeah, we
building.
do that all day. Yeah,
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 down the street.
yeah. Just open the yellow pages and
Yeah, exactly. 1-800 got property. So yeah, so what we'll do is we find this property, we put it under contract. We've got the deal. We have the expertise to manage it. We can get the financing for the deal because banks love lending on multifamily, but we don't have the $10 million we need to close
right,
on it.
right.
We will then go out to our network of investors and we will raise the capital needed to do the deal. And the most efficient structure for that is a syndication. Um, and how the deal is set up in terms of splits and fees, that varies on a deal to deal basis, but the investors are able to invest in real estate, get all the benefits with it, and have it managed professionally by two amazing real estate people like you and I. And after 5 years, after we've implemented our business plan, we're able to sell and move on to the next deal.
Now, is this different than private equity, or does this fit under
It
that
is.
as well?
It is private equity.
Okay,
That's
okay.
exactly what it
Yeah.
is.
There-
Yeah.
There's just a lot of terms out there. I don't know
Yeah.
if everyone knows what they all are.
Yeah.
So private actually equity is so that's the term Tiger 21. You're familiar?
No.
Oh, gee, come on. Okay, so I've mentioned it a couple times on the show.
Oh,
Seth,
actually,
the rich people.
Is that the report that they publish a report and
Yeah.
all that stuff?
Yeah.
Oh, yeah.
So Tiger
Yeah.
21 for
Yeah.
the listeners' benefit. Tiger 21 is a network of investors with $10 million investable capital, $10 million and up, and so they survey it once per quarter, and then now I actually think they sell the survey results.
Probably.
Because I think it was so they're probably smart money. If you manage to amass $10 million of investable capital, you might be smart. So everyone's interested in like, what are you guys doing? And so private equity is, I think, somewhere around like the third largest piece of the pie.
Oh, it's huge.
Yeah, it's huge. So I believe real estate's the largest, and then public equities, it's like stocks, like Apple. These aren't recommendations, folks. So Apple, Tesla, Macy's, those stocks, and then third is usually private equity.
Yeah. So like on the commercial syndication side, like syndication is private equity because we're using private equity to do these deals. But I think in terms of like how Tiger 21 does it, I think they count private equity as in more like venture capital, stuff like that. I'm pretty sure. I don't know how they break it down.
Yeah, I don't know how they break it down either.
Yeah.
Because if the survey said private equity, I'd probably put it there. Because
Yeah.
by definition it is, even though it's real estate. But
Yeah, but when you first said Tiger 21, we were talking about Tiger Woods before, so
Yeah,
I thought
right.
that was a book or something.
right.
But yeah, so what were we talking? We were talking about. Oh yeah, so the whole reason, like these commercial real estate investments, they're called alternative investments. The reason is it's just an alternative to Wall Street investments.
Right.
So whenever you're speaking with the bank or something,
Yeah.
and your financial advisor, quote unquote, at the
You're a
bank,
mutual fund salesperson.
yeah, they'll say, oh well, you don't want to get into alternative investments,
Yeah.
but
Just like you're not interested in alternative energy because it's bad.
exactly.
Let's burn
Well-
coal and oil.
Well, the whole reason is that the guy at the bank or your mutual fund, like, they don't earn commissions
Yeah.
on if you go put your money to work harder
Yeah.
in a real estate deal.
Yeah. No, they'll probably get fired if they
Yeah.
mention any of this stuff.
Oh,
They recommend any
sure.
of this stuff.
Yeah. Yeah.
Like, don't kid yourself, folks. People are like their jobs depend on their ability to sell the company's products.
100%. But and then we even talk about we look at insurance companies when it comes to multifamily real estate. You will pay your premium to the insurance company, and how does the insurance company pay out your life insurance? They go out and buy multifamily real estate.
Yeah.
They own so much commercial real estate out there.
Right.
So basically, yeah,
Yeah. To your point, like CPP owns tons of real estate.
tons.
Like they're playing monopoly. They own utility companies.
Yeah, but when you look and speaking about the Tiger 21 report and CPP, when you see real estate, we're not talking about houses, right? That's the one thing. Like you look at all these these wealthy family offices or CPP mutual fund companies. When they say, yeah, we own a lot of real estate, they're not talking about your duplex or your single family home.
Oh.
But we're talking about large multifamily properties, mostly because of the cash flow and the stability.
Mm-hmm.
Yeah,
And the scalability, because
huge.
especially financial institutions, like they place large amounts. They're not going to place 50 grand. They're not going to place 200 grand.
No, you're buying like $100 million assets.
Yeah, and then they're probably deploying like tens of millions at a time.
They have entire divisions
Yeah.
of their company focused strictly on their real estate asset
And
management.
CPP usually does pretty well, so thank you,
Yeah.
CPP. We depend on you.
Yeah,
I'm depending on my CPP.
you are? No, no.
Hopefully, no one on this show depends on the government for their retirement.
No, if CPP's even there when we're old.
So I remember you've told me before about this business model as well. I don't know if you know, because most people are familiar with REITs.
Yes.
Or like BRRRRs, where they'll hold the property.
Mm-hmm.
Right, their plan is to do whatever they need to get to the property, turn over tenants, whatever, to increase cash flows, make it a better performing asset, and then they typically hold.
Yes.
Right, is that the model that you guys do in the States?
No. So I think, well, let's back up. We'll talk about like the burst strategy, and then we'll talk about selling versus holding long term. So everybody's watching on TV all the flip shows.
Mm-hmm.
It's almost the same process when you're flipping an apartment building, except the time frame's much longer.
Yeah. So instead of half an hour, it's an hour.
Yeah, exactly. So like, okay, so let's say it's going to take you 2 months to flip a property. Like we're looking at 3 to 5 years to go through our full value add plan.
Right.
In an apartment building. Obviously, we have more units,
Yeah.
and you're going to do things, do renovations and updates as the units turn. So as people move out, and it's just a much bigger scale. So if you're right now, if you're familiar with flipping homes, updating houses, it's the same thing. Like we're looking at kitchens, we're looking at flooring, we're looking at colors, painting, exteriors. It's the same idea. It's just different. That's all. Now talking about whether we should hold forever or sell, we get into the discussion of return on investment versus return on equity. And then we also have to factor in depreciation. So a lot of people, and this is the thinking I had when I first started in real estate, I'm just going to buy a whole bunch of houses and hold them forever, which is great. But when we're factoring in these large scale investments, we have cost segregation that we're able to use in the U.S. So in the U.S., we have commercial real estate that depreciates over 39 years. We can wait for 39 years and depreciate, but we're able to use something called cost segregation, which is going to pull out all the non-real estate components of the building so we can front load depreciation. So your flooring, the electrical wiring, your light fixtures, that's pulled out and depreciated on a different scale. Then we have sidewalks, parking lots, that sort of stuff. We can depreciate that over 15 years, not 39 years.
Nice.
And with the first stuff, you can depreciate that over 5 to 7 years. And then the building itself, the shell of the building, depreciates over 39 years.
Right.
And then the land itself does not depreciate. So what you're doing is you're optimizing how you depreciate the asset. So why would you wait 39 years on something when you can depreciate the parking lot over 15? Right time value of money. It's better you take the tax credits now.
Yeah.
Same thing with all the flooring and all that stuff. So you're just using depreciation in a smarter way.
Right.
So the question now is, how does that factor in to if I should hold forever or sell? Well, we front loaded our depreciation. Our investors get a paper loss on day one. That wipes out a significant portion of their tax that they'll pay on the returns they earn. After 5 to 7 years, your depreciation tax credits start to run out, right? Because we front loaded everything.
Right.
It makes more sense at that point. You've already gone through your value add system in the property.
Mm-hmm.
You're maximizing your return on investment. Now you have a whole lot of equity. So now you have to look at return on equity versus return on investment. One option is you could refinance and put new debt on the property and return some investor capital, but you're still missing that tax, but the tax benefit portion with your tax credits.
Right.
So oftentimes it makes more sense to sell in year 5 to year 7 and then restart the cycle all over again in a new property.
Right.
So it's just using the tax code more efficiently.
Right.
And that's why you'll see with these larger syndications, you'll see them hold for 4, 5, 6, 7 years, and then they'll be looking to sell and then roll into a new deal.
Wow. So you tell me, like, I don't see this model much. Like, I think you're probably the first person to tell me this model where you guys dispose of the asset. That sounds terrible. You're taking your profits.
Yeah, we can see we divest ourselves of the asset.
You and I both do stocks and we do small real estate. We take profits when we sell, essentially. But you're taking your profits of year 5, 7, which is not common for these large scale investments.
It's very common.
Is it like more of a because of the tax? How the tax? Oh yeah, you guys have the rollover thing in the States.
Well, no, we're not talking about 1031 exchanges. That's different.
That's still awesome, though.
Yeah. No, when you're talking with these large apartment buildings, it's very common to sell because
but we don't see it here.
It depends on the scale you're looking at. Once you've implemented your value add plan, let's say you're same with stock hacking. Once you've gone to 80%,
right.
Why are you holding it for the last 20?
Yeah.
Right. Sell and then you move on to the next project because you want your money working as hard as possible.
You've received 80% of your profits. Why not move? Why not turn over that capital?
100%.
Okay,
actually, that's a good analogy. I'm glad we came up with that. So it's the same thing. And obviously with apartments, you're always going to leave some meat on the bone for the next buyer.
Yeah.
You're never going to renovate 100% of the units. Oftentimes you're renting 40, 50% of the units so the next buyer can make money on it.
Right. So, well, not all the tenants want to leave either.
Yeah, exactly.
Right.
Yeah.
So there's still lots of small nuances I want to get through.
Oh yeah, for sure.
Because it's not, folks. This isn't. Okay, like for example, when you're renovating a property, like what is your unit range of your deals?
Yeah, so right now we're actively hunting deals between 100 units and 250 units.
Okay.
Yeah.
So it's like a weekend. You can do about 40% of these units, renovate them. How many renovation crews do you have working on a time on a project?
Yeah, so oftentimes like you're not doing a lot of units at the same time because you're doing it as you turn.
Yeah.
So let's say you're acquiring a property with like 96% occupancy, like physical occupancy, like you're maybe having 1 unit or 2 units a month turn. Like that's not a lot. So you can have one crew just do both units.
Wow.
Yeah, it's not a lot.
Really?
Now, let's say, for instance, you're buying an unstabilized asset.
Right.
Where it's a big, heavy lift and you've got 60% vacancy. Like you're going to renovate as hard as you can. So you've got an entire crew, like entire company going in and just doing the whole shebang.
So how many units would be working on at a time?
Oh, for that, you could have multiple units. Like there's actually a potential speaker coming to the conference next year. We'll be focusing just on that. We haven't made it official yet.
Right.
But that's the whole unstabilized asset game. That's a totally different play than what I'm focused on, which is more like your kitchens, bathrooms, that sort of thing. The physical value add, and then you have operational value add. So better management, improved systems, that sort of thing.
Can you? Are you looking for like any efficiencies? Like for example, if there's no dishwasher, do you put one in? Are you doing anything with air conditioning, heating? For efficiencies.
It all depends on the market. So for instance, perhaps in a market you're looking at units, you can get a $75 premium per unit if you include your washer and dryer. So at that point in time, okay, you have to look at the numbers. So what's my cost to either lease a washer and dryer or finance a washer and dryer? What's that going to cost me per month? What's it going to cost me to install it in the unit? Am I going to make money? If the answer is yes, it makes sense to do it, right? So you're always just looking at making the most efficient upgrades to the unit.
Mm-hmm.
But in some markets, people will bring their washer and dryer in. Like it all depends on the market.
Wow, there's actually markets that.
It all depends.
Yeah, it's just now it's happened to me a couple times.
So
they ask if they can bring their own washer dryer. I'm like, where are you gonna put it?
Yeah. So it all really depends. Like in some markets will have different standards. So like for instance, if we're in a tertiary market, granite countertops might not be the best thing to do. But if we're in a primary market like a Toronto, like granite countertops are almost standard. If you're in that like kind of B to A range,
right.
for sure you need that.
Can you name some of the cities that you guys are investing in?
Yeah, for sure. So we've got Orlando, and
every Canadian knows where Orlando is.
Yeah, and then we're actively hunting. We've got 6 markets we're looking at. So we've got Dallas, Fort Worth. We've got San Antonio, Houston. We're looking at Phoenix. We're looking at Charlotte, North Carolina, and then we've got Orlando.
Oh, cool.
So, yeah,
we can go on a nice golf tour.
Yeah, we just need the border to open up because it's been over a year that the border's been closed, and so I've got guys on the other side of the border, but it would be nice for me to go down
soon.
Yeah.
I don't think it's long. I don't think it's long. Yeah. So, for example, my family in Hong Kong, I think come June, the border with China, a lot of their borders open up because they've been fully vaccinated.
Yeah. So yeah, don't get me started on Corona.
Yeah.
So
that's not started. Things could be so much. I was talking to one of my mortgage friends this morning. He's like, "Oh, frustrated." Like, I'm like, "Hey, you're making money, aren't you? I just saw you got an award for it. You're like one of the top mortgage people in Canada."
Yeah.
He's like, yeah. There's lots of people not making money.
Well, that's the thing in real estate, right? It's like the 80-20 rule, but it's like 95-5. Like 95% of all the real estate agents and mortgage brokers don't make any money.
Right. So. But count our blessings because we're essential service.
That's true. We are actively talking about real estate right now.
We are. Well, yep. Yeah. And and then we do business. We're still open, right? We're still able to do business. So, and our investments are doing really well. Like your investment, we talked about the bad of coronavirus. How have your assets in the States performed?
Really well. So
because money's chasing hard assets.
For sure. And I think like over the next 10 years, like there are so many different drivers like pushing the commercial real estate space. But yeah, I like with Amber Lakes, as soon as like when Corona first came in, we noticed how our vacancy dipped down. Just because everything got shut down.
Sorry, what city is that?
Orlando.
Okay.
So all the colleges shut, like everything shut down. Yeah. So vacancy dropped. But after 3 months, we were right back up. And I think, that speaks to the strength of multifamily real estate. Like
right.
You're able to, when we acquired it, I think occupancy was like 93%. And then it dropped all the way down to like 80%. But we were still like nothing. Like we were still able to pay all the investors like their annual returns. Like nothing changed.
Interesting.
Yeah.
Well, I don't think that just says multifamily. And just in the building location, all worked out well because Toronto rents haven't come back.
No.
Right.
No, but it's how can I like? But here in Toronto, like, we've got rent control though.
Yeah.
So it's a different thing. And with us, like with Amber Lakes, like we still have, we're still giving out, we still have incentives for tenants.
Uh-huh.
So the rents may not have bounced back to 100%.
Right.
But like the occupancies definitely bounced back.
Well,
and
that helps.
Yeah, and the scale of the property, like because the cash flow is so strong,
mm-hmm.
like it's like, let's say you had a fourplex. And you lost, one of the units. Like they moved out and it was vacant. That's 25% mm-hmm. of your revenue gone. Mm-hmm. With a multifamily property, like you just don't have that. Like mm-hmm. The scale works in your favor. Mm-hmm. So even if you're operating at 80% occupancy, as long as your underwriting is good, like your cash flow is still very strong.
Really?
Yeah.
You can handle a 20% haircut?
Oh, on that deal, we could handle a 40% drop.
So at 6% occupancy, you guys would be like, it would take a 40% haircut to be break even?
Yeah,
That's
that's right.
pretty good.
That is good, but again, like that's why lenders love multifamily.
Right.
That's why investors love investing in it, because you can look at an asset and how it performs in the good times.
Mhm.
It's like stocks too, right?
Mhm.
But it's how the stock handles or how the property handles the downturns. And over the past two recessions, multifamily has absolutely like outdone office, retail, industrial. It bounces back quicker, it has a shorter downturn, and it surpasses the previous peak faster.
Right.
So that's one of the things I was looking at when I was looking at making the switch from single family to multifamily. Okay, well, how do all these assets perform
Mhm.
in downturns?
Mhm.
And multifamily by far outperforms.
Right. Well, I imagine because of coronavirus, money left a lot of commercial real estate, specifically like office, retail, and would naturally migrate to residential.
Yeah, multifamily is always that stable kind of asset.
Yeah.
So whenever you have things getting rough, multifamily does become that asset of choice.
So something we didn't cover yet is why your model, I think, is fascinating because I don't know what you can share about returns, but the returns are quite high.
Yeah. So what we do is we look for deals that pencil between 15 to 17%.
To the investor.
Yeah.
Right.
We're talking annualized. Yeah.
Right.
So
like, do you know any REITs that pay that?
But it's very a REIT's very different because like
Yeah.
you just own a stock in a company that happens to own real estate. With the syndication, like you actually own the syndication owns the real estate, so you have direct ownership.
So you participate in the upside and the downside.
Oh, for sure.
Right.
Yeah. So with we were talking about returns, right? Yeah. So what happens is I call it the breadcrumbs, then you get the cake. So as you hold the asset, you are receiving your quarterly or monthly distributions, depending on who you're investing with in the property and the syndicator. So you're going to receive your breadcrumb distribution. So this could be, 8%, 7.5% a year, depending. So the way syndications work is it's set up on a split. So a common split in the industry is 70-30. So 70% is in favor of the limited partners, the investors, and then 30% is in favor of the general partnership. So let's say, in year one, the investors get returned 7%. Then in year two, as the rents continue to increase in the
wait. You're getting money year one?
Oh, yeah. Yeah. So
because you have cash outflows, like you're renovating, for example, and
yeah, but like this is like my mind was blown when I moved from a single like doing duplexes and stuff to these large multifamily properties.
Because single family, like you paint, you do some tear up the carpet, it's gonna cost you like $5-10 grand.
Yeah,
there's no cash flow first year.
that's right. Yeah, so yeah, like the scale works in your favor. So let's say hypothetically in year one, you're being returned 7.5%. Then as you implement your business plan, you're increasing your rents, your average rent per unit goes up. Then maybe year two, you're 8%, then 8.5%, then 9%. And then when you go to sell in year five, right? So you've earned your cash flow. This is the breadcrumbs along the way. And then when you go to sell, you've improved the property, you've compressed the cap rate, NOI's gone up. You're selling, you're hitting your targets. When you sell, that's when you get your big fat check. So it's the breadcrumbs, then you get the cake at the end.
Mm-hmm.
But the cash flow is quite strong during the hold period. But obviously, you get your big. And then if there's a refinance after year two or year three, you can get some capital returned at that point.
Right.
One thing you should watch out for if anybody's listening is, and you're looking at these investments, the refinance should never be worked in to the underwriting model. The reason is you can't guarantee that a refinance is going to happen. So if somebody's guaranteeing you that the refi will happen year three and you're going to be getting back 40% of your investment, you can't bank on that. I look at refis as a nice to have. Like, if it happens, great. And obviously the investors are happy if you get 40% of your initial investment back in year 2 or year 3, but you should never bank on that.
Pretty cool. This is pretty cool stuff.
Yeah.
Because this is why you're on the show, and also why I asked you about the model.
Yeah.
Because again, like these returns are not typical for a passive investment.
No, this is why real estate is like multifamily is so strong. And obviously it depends. Like, I know I'm friends with some people who they do exceptionally heavy lifts. They look for very distressed assets. Not my thing, but that's what they do. Their returns can be much higher.
Crazy, yeah.
But then the risk. With me, I would rather buy a cash flow positive property that has cash flow and have the wins, but not have a huge home run type of thing. But there's different models and other syndicators. If their strategy is more like a core type of strategy where you're buying in a major city right at the core and holding it for 10 years, your returns may be less, but some people may feel that's a more less risky strategy. So you may be looking at 12% annualized returns as opposed to 15 to 17. It all depends.
So on the exit, what happens? You said you're talking about cake.
Yeah.
So you get your money back.
Yeah.
Is the return, that's the highest return payment as well?
For sure, yeah. So when we're talking about 15 to 17% annualized returns, like that's including the sale, right? So basically as we're managing a deal, we're looking at the market, what are comparable properties selling for. As soon as we feel we can hit kind of our targets that we set out to hit, we will look to sell the asset.
Fascinating stuff.
Yeah.
And then you, last time you were on the show, you talked about division of duties for general partners.
Yes.
Can you share about that?
For sure. So there's all sorts of different strengths that people come with. And when you're dealing with a large, let's say you and I are doing a deal for a 150 unit apartment building.
Yeah, because we do that every weekend.
Yeah, every weekend from the golf course. Yeah, so there's lots of things that have to happen, right? So we have to raise capital for it. Then we have to seek financing for it. Then we have to manage the renovations and the construction projects for it. Then we have to have somebody manage it. All these things have to happen. And oftentimes the person who is raising the capital will not be the best person to do the underwriting and do the spreadsheets.
Right.
So the general partnership, sometimes it can be a single person, not often at all.
For a smaller deal.
Yeah. But for these larger deals, you can have a team of 6, 7, 8 people working in the general partnership, and they all will come with specialized skills. And that's one of the beautiful things with multifamily is, if you and I bought a duplex, we would have to wear 5, 6, 7 different hats and do everything. With multifamily, if your strength is raising capital and bringing on investors, that's all you do.
Right.
And then if your strength is underwriting, you will be underwriting all the deals that are coming your way. You'll be underwriting and looking at the market, analyzing performance. Maybe your strength is construction management and there's a construction component. Maybe we've bought a property where there's an opportunity to add another building beside it. Your job is not raising capital. Your job is not underwriting. It's just to perform on the construction side.
Right.
So
it's like who not how.
Yeah, exactly.
Especially if you have a specific job skill and you don't want to do the other things, grab some buddies who have other skills that you don't.
Yeah.
Makes sense.
Yeah. So at the end of the day, I think the investor gets a better product and a better investment because you're able to have people who are exceptional at what they do, managing that component of the deal. And plus you have like the tax benefits and all that stuff too.
So then one of the things you bring to the table is you're on TV. Well, you're on several more forms of media.
Yeah. So we've got the YouTube channel. So I post a new multifamily video every week talking about some component of multifamily. So that's youtube.com/Seth Ferguson if you're interested. But yeah, I've got the TV show, which is a general interest real estate TV show. And then we've got the podcast, Real Wealth Through Real Estate. And that's not specific to multifamily. Like we'll talk about mobile home parks. We'll talk about even single family portfolios and stuff. Yeah.
Yeah, and then I always want to let the listener know, like, there's a spectrum of investments.
Oh yeah.
right? There's no really one right answer.
Yeah.
There is good, better, best, but again, like what fits you,
Oh, for sure.
right?
Like, sometimes I'll have conversations. Somebody will get in touch with me, and they'll say, Seth, I really want to be involved on the active side of these deals. Well, if you want to be active, then you probably shouldn't be a passive investor because
Right.
you have no control over the deal.
Yeah.
It all depends on what. That's why I keep going back to like the my decade vision. Like, where do you want to go? If you want to be really active and you enjoy talking with people and you like hospitality,
Yeah.
well, maybe do Airbnb.
Yeah.
Like there's, but I would say generally speaking, the investors that are attracted to the multifamily side, they're high net worth individuals. They're very successful at what they do, and they're looking not only to put their money to work hard,
Mm-hmm.
but they're also looking for those tax benefits, which is a big part of it, right?
Mm-hmm.
Yeah.
There's a Warren Buffett quote that I don't think gets nearly enough attention, where he says, "If you're not willing," I'm going to paraphrase, folks. Sorry, apologies. It's hard to find. It's actually really hard to find. But Warren Buffett along the line says, if you're not willing to put in 6 to 8 hours a week in doing, your investing job, then if you're not willing to do that, then you're an amateur,
Mm-hmm.
right? If you enjoy it, go ahead and do it, right? If you're not, you are therefore an amateur. Go back to your day job, invest passively in the index.
Yeah.
Right.
Yep.
And so same thing. Like, again, truth about real estate is you want to be professional. It's going to take you more than 6 to 8 hours a week.
Way more than
Way
that.
more, especially at the beginning.
Yeah, 100%.
Yeah.
Yeah.
You're not the guy in Ireland drinking Guinness at the pub. This ain't no 4-hour work week.
Yeah.
Not at the start. Not
No.
near. No.
No.
And so, sorry, you were talking about Texas, and before we were recording, we were talking about Alberta as well.
Oh yeah.
So I don't know, like, what is the future for Texas? Because when I think Texas, I think oil.
No, Texas, like when you look at the main, for instance, Houston, largest cancer medical research center.
I had no idea.
Oh, like so much, and there's so much growth happening. So when we look at the U.S., it's really interesting to look at the migration, the interstate migration patterns. You have the both coasts, so California, New York. Everybody, like tons of people are leaving every year. And where are they moving to?
Yeah, the taxes are the highest in those places.
Taxes, but what happens when the tax situation is better for business? Business grows, right? So you have a boom right now happening in states like Arizona, Texas, right?
Florida.
So much growth happening there. And when we look at what drives a real estate market, you look at GDP growth, and that's going to bring the jobs, and people move for the jobs, and that puts upwards pressure on rents. It all like. I think over the next 10 to 20 years, we're going to see a huge shift in how the population is spread out in the U.S. You look at California; they're taxing business to death. Even I was joking about the Joe Rogan setup here. Joe Rogan left.
Left.
You look at all the businesses leaving.
Tesla's opening up.
Yeah.
Manufacturing in Texas.
Yeah. You need business, right?
Yeah.
You can't grow an economy through taxation. It's the opposite. You have to free up business to do what they do best.
I think it's brilliant what Elon does is that, he has shop. He's not political. He's opened up a shop in all different places, right?
Yep.
So you can never blame him for being political. Like he does not affiliate with any party. It's hilarious. It's hilarious because then like Texas state governors are big fans of Elon because he's bringing jobs.
Yeah.
Right?
Oh, for sure, 100%. So those, and there's a reason when I rhymed off the markets we're looking at, like those we look for the growth drivers,
right?
And
tenant-friendly laws,
right?
Just like Ontario.
I did a live stream with Kayla from Ontario Landlords.
Oh, that's what you did. I thought you had it on the show, but that's what you did.
And I get ranting, and then I have to.
It's not healthy.
Yeah.
Let's just go count our money and be okay with it. Go golf instead of ranting. Yeah. Because we could be here all day.
Oh, we could be.
I don't think anyone would keep listening. Oh, so conference.
Yes.
Why did you choose? Why the decision to do a conference?
Well, A couple of reasons. Number one, I wanted to hang out with really cool people at the
Like Kevin
conference.
O'Leary, yeah.
Yeah. Oh yeah, Kevin O'Leary is the keynote, and then we've got some other great, Rod Cleese coming to the conference too. Big multifamily guy, Richard
Like,
Wilson.
sorry, what's big is big? Like 150 units already sounds big. If you own 150 unit building, that's a pretty big deal to
Oh
me.
no, Rod owns thousands and thousands of units, and
Okay.
he runs a really successful multifamily training program too. So he's going to be a great guy. He's going to be focusing on mindset and how to structure yourself and get ready to take the plunge.
You obviously have to think big.
For sure. And then we have Richard Wilson, who is one of the foremost guys about raising capital. He runs the Family Office Club. Really smart guy. Then we have Edna Keep, who has she been on your podcast?
Sorry?
Edna Keep.
No, she
oh
hasn't.
yeah, she's from out west, multifamily Canadian. So she's coming. And we've got Mike Reed coming in. Who else? Oh, then we've got some people we haven't announced yet. But yeah, we've got a great lineup of speakers. So that's happening May 14th and 15th, 2022 in Toronto.
Right.
So
I'm sure everyone's seen your ads.
Oh, probably. And yeah, that's going to be ramping up later on this year, like marketing.
More?
Marketing.
I
will
see
be
an ad
full
at least
force.
once a week.
Yeah, it will be full force.
I like that one with the shark coming at you.
Oh, yeah. So we've got a couple things with that. But yeah, why did I do the conference? Well, I think like Urban, you've been around real estate for a long time.
Yeah.
But we've had a conversation about how these deals are structured, the possibilities. I've probably mentioned something that you weren't familiar with, right?
Oh yeah.
Right. So I think more people have to know about it, because when I first started investing, I had no idea this world existed. And now that,
most don't, because it's not in their context.
No
one's shown it to them.
So what a perfect way to bring this and educate people about other options and what they can do, than have a conference, bring like the top people from across North America and put on a really kick-ass event, right?
What's Kevin think about real estate?
Well,
he's all over the. I don't know where he is now, because I've heard him talk both sides.
Well, he's got his O'Leary funds, but the thing I like about Kevin is he's very astute and he's a shrewd investor. And so one of the things I spoke with him and his team about, what I wanted him to speak about was the nature of capital. How does capital move? That sort of thing. So we've got the guys coming in like Rod to talk about the multifamily side. And we've got some other great speakers talking about the construction component side and how to add value to your deals and all that. But with Kevin, I really wanted somebody to talk about capital as like a bigger picture, and how does capital move in the markets and that sort of thing. I think it's going to be really, really fun.
Awesome.
Yeah.
Do you have someone talking about how to find deals? Because
Yeah,
I think it's way harder than anyone thinks it is.
Oh, especially now the way the market is, it is incredibly tough.
Yeah.
And
if anyone doesn't believe us, go look it up. There's a Financial Post article that said $47 billion have left Hong Kong in the last 12 months.
It's
You don't think any of that money's looking for real estate?
there is so much money right now.
That's just one little island.
It is nuts. And right now in the markets, like Texas, Houston. Sorry, did I? Oh, I said DFW, Houston, San Antonio. Like there are so many out-of-state buyers competing for deals.
Yeah, like Middle East money, Asian money.
It's just nuts. And even among different syndication groups, like there's so much demand for the good deals because they're few and far between. So yeah.
Do you know where most of your money's coming from? Are you able to share that? Is it mostly overseas, mostly local?
No, our investors are from Canada and the U.S.
Oh, okay.
So yeah, it's just we work with accredited investors. So you hit the accredited investor threshold.
Has to be accredited. You can't be the 70 grand guy.
Well, like 70 grand a year.
Yeah.
Well, so there's I guess we can break it down in two types of offerings. So you have 506B and 506C.
We're getting gritty.
And well,
apologies, folks.
Yeah. So basically,
I like details.
Okay. In a nutshell, there's an opportunity to have non-accredited investors, and you can advertise your deal. And then the other side, you are limited to accredited investors only with a couple of exceptions, and you
Right.
can't advertise your deal.
Right.
This is why the general public didn't really know. But yeah, generally speaking, we prefer accredited investors to work with us on our deals. It's oftentimes they're more experienced on the investing side. They have a team already behind them, like a good accountant, good lawyer. They're able to be supported through the investment.
Right. So you don't have to educate them through everything.
Exactly. Yeah. But speaking of education, though, I should shameless plug. We're launching our beta course next week. So the course is geared towards somebody interested in passively investing in an apartment deal. Because what I found is, I'll talk with a ton of people every week, and a lot of them, they have the money they want to invest, but they don't know how to look at a deal. They don't know what they should be looking for, what questions to ask. So we've got an 8-week program that we're launching, and it's just going to walk the investor through, okay, well, this is where we should start. This is how you look at a deal. This is how you look at syndicators. This is how you build your team. This is how you grow your passive portfolio. And it takes them through the entire process. So
that's good.
Yeah, I felt, because I found like I was going through the same questions with every single investor. So I'm like, whoa, wait a second. Like, this is something the market needs. Because there's a lot of appetite, and there's a lot of inquisitive people who want to learn. It's just I couldn't find anything that met that demand. So we created it.
Where can they find it?
Yeah. So when is this going live?
Soon.
Okay. Well, if it goes live next week, you can go to discovermultifamily.com and and hop it. But we can't launch this episode until we're ready to rock and roll.
You're good for Friday?
Next Friday? Yeah. Oh yeah.
This coming Friday.
Okay.
Not today.
Next. Oh yeah, we're good.
Okay.
Yeah.
Okay.
Discovermultifamily.com. We're good. It'll be ready.
.com. Ooh,
yeah.
Big time.
Big time.
All right. Where were we? Okay. Oh, can you remind me? What are the qualifications for accredited investor?
Yeah. So the two most common ways are you can have $1 million of net assets, not including your principal residence.
Right.
So if you have $1 million in your stock hacking account, that works. Or you can meet the income threshold. So that's $200,000 a year, or as a couple $300,000 as a year.
Fabulous.
For a year. Yeah.
All right, you said Stock Hacker Academy, so I have to ask.
Yes.
And it's a funny story because you came into the Rockstar office to interview me for the podcast.
Yes.
And then you told me what was up with your JV gone bad.
Yeah.
And I said, "Yo, man, you need to learn this stuff. Call it stock hacking." And then you took me up on the offer and you came that weekend.
I did, and you know what? I think that was a very good decision. But before, I was very ignorant when it came to the stock market. I had, when I first started making money, I got a RSP mutual fund, like I thought everybody was supposed to do, and and you look at the returns, it's like, why am I doing
how'd that
this?
work out?
Not very well. But so that was my experience in kind of stocks. So when we were talking, you were obviously very passionate about it. So I'm like, you know what? I have nothing to lose. Might as well do it, and I'll learn something. And it's gone quite well. So I started off with 10 grand in the account because I didn't really have much at the time.
I was tied up.
Yeah, but now I'm almost 200 grand trading in the account. I'm on track to do, I think, high 30s for percentage annually.
Fantastic.
Which is okay. I haven't got into spreads. I'm still just doing the basic puts and stuff. But yeah, it's going really well.
Awesome.
So ideally, I would like my goal, like obviously with the real estate side, that's my passion, that's my love. But I'm having fun with the options.
Isn't it fun?
Yeah, and hopefully soon I'll be up to like 500 grand or so in the account.
Nice. Probably by next year.
We'll see how things go.
Oh yeah, money being.
If I can get my money back, yeah, we're good. And then I think at that point, like, what else can I ask for? Like, the money's making a good return.
Yeah.
And one thing I was looking at, I had this one old life insurance policy that I got because my dad told me I needed it. So I was pumping like 12 grand a year into this, And the whole thing was, oh well, you'll earn 6% a year on your money, and when you're 65, you can retire. And then I'd done the math. I was like, wait, like why am I doing this? Like,
All right.
sure, the insurance side is good, but I could buy a term policy for way cheaper.
Oh.
And
Is this whole life?
yeah,
Oh, we should talk.
yeah.
You can borrow it,
Well, yeah. Well, but the problem is there was nothing in the cash value.
Oh.
But yeah. Anyways, we'll talk about how the policy was set up, but it wasn't geared towards.
Crap.
Yeah. So that policy wasn't geared towards like
An investor.
That infinite banking kind of concept.
Ah, crap.
So basically, for the first 5 years, you're just paying fees, and you're paying the person who wrote the policy.
Right.
So I worked it out. I'm like, you know what? If I would have started stock hacking when I first got that policy, like it would have been night and day, and I would have been self-insured. Like, so. Anyways,
crap.
But yeah. So stock hacking has been a whole lot of fun.
Right.
I'm just, when is the next pullback happening? Because right now the SPY is trending up, and the last pullback we had, when was that? That was like a month ago, I think, right?
Yeah, NASDAQ pullback.
Yeah, I was like, crap. Like I wish I had more like dry powder to hop in. So when's the next pullback happening?
Don't know. It might be soon. The market's already tentative, right?
Yeah,
it's low volume,
and like VIX is really low right
dry.
now.
Yeah.
Yeah. So I'm kind of waiting on the sidelines. Obviously, I've got a whole bunch of puts I wrote that are almost near that 80% rule, so I'm sitting pretty good. Yeah. I'm just hoping for a pullback so I can go in and make some money.
Might be soon.
We will see.
I've actually started buying some calls because the VIX is so low.
Yeah.
Bought some on Walmart, bought some on Apple.
Nice.
That's working out.
Yeah.
Awesome.
But yeah, just gotta say thanks for bringing me into the world of stock hacking.
Just here to help, just like you are, trying to help people.
Yeah.
Like we can rant as much as we want about coronavirus. We financially, it sucks. It sucks to have our freedoms limited.
Yeah.
But financially, we've done pretty well.
Oh,
for the last 12 months.
There's no complaints at all. Like, okay, so let's put it this way: if you're earning, you've got 200 grand in your stock hacking account, and you're doing like, let's say 35% on your money, like you're doing okay. Yeah. So
yeah,
what's your account up to, or can I not ask?
I'll tell you after.
Okay.
It's up there now.
Nice.
Yeah.
Nice.
But yeah, but I have most of my money's in real estate though.
Yeah.
Yeah. I still like boring. I like boring.
Mm-hmm.
Well, market's went up 20% last year. Like,
it's just
how
crazy.
can you complain?
Yeah. Just crazy.
I know, it's just crazy. And we'll talk more offline about where we think things are going. So the conference isn't driving you crazy? It drove us crazy.
Yeah. Well, I remember. I think I was one of the first people to sign up for your conference.
No way.
Yeah. Like
Thank you.
As soon as the email came out, I was like on there right away. And bought the VIP ticket, so that was cool. It's actually a lot of fun. The lockdowns kind of made things difficult because the venue was shut down for a while. The hotel.
Sorry, what's the venue?
Oh, it's the PowerAid. Actually, it's not called PowerAid Center anymore. It's the CAA Center.
Oh,
yeah,
interesting.
Yeah, so we're the CAA. It used to be called the PowerAid Center. So it's going to be so cool. So we've got it's a hockey rink. The ECHL Brampton Beast used to play in the rink.
I played there.
Yeah. I refereed there in the OHL many times. So we've got the stage where Center Ice is coming. We've got our Platinum and VIP seating on the floor. Then we've got everybody in the bowl. The production team we have working on it. It is going to be unreal. It's going to be awesome. But lots of room for people. The VIP tickets, you get meet and greet with Kevin. We've got a special VIP lounge for like networking and the food. Mm-hmm. We've got an after party for the VIP tickets on Saturday night. And we're looking at venues right now for that. It's going to be sick. So, yeah.
I still need to check with TAREI on the date. I think I have the okay. Hey, do I have a discount code?
Yeah, we can do a discount code. What do you want it? Discount code IWIN?
Yeah, 4 letters.
Yeah,
IWIN.
IWIN. Okay, we'll set that up.
All right, awesome.
Yeah.
It'll be ready by Friday.
It'll be ready. I will send an email after this, and I will make sure it gets set up for you.
Awesome, and we'll include it in the show notes, folks.
Yeah.
And then where can people find information on the conference?
Go to multifamilyconference.ca or just watch for one of my ads. But yeah, multifamilyconference.ca. All the tickets are available right now, but we only have a very limited number of VIPs and Platinums, and basically almost everybody's buying the VIPs and Platinums right now. So
Interesting.
yeah.
Yeah. And then from my experience, the VIP was the first to sell out.
Oh,
Yeah.
it's awesome. Like your event was so well run. I can't wait until you run the next one. And yeah, like just the quality. Like I see who buys tickets. The quality of people we have attending already is unreal.
Yeah.
So if you're interested in just if you're getting started in multifamily, if you're curious about it, or if you just want to learn how to scale your portfolio, or hear Kevin and these other capital raisers speak, it's a 2-day event. It's going to be so much fun.
Mm-hmm. Yeah, the networking. Whenever you go the highest level for networking, the networking is usually much better than if you take like the base level ticket.
For sure, and we've actually like designed the VIP experience for networking.
Right.
So we've got the special lounge there, and there's some other goodies and stuff the VIPs will get. But yeah, it's I'm so pumped for the conference.
Right. Yeah, the veteran VIP members know that. The attendees know that because they, someone spent a good amount of money to sit next to you. Like somebody you should probably know. At least say hi to.
100%.
Awesome.
So yeah, it's I'm so excited for the conference.
Awesome.
Yeah, ask me in 6 months when it starts getting more stressful. But right now it's good.
Dude, I was stressed from the beginning because there are a lot of cash outflows that go up from the very, very beginning.
Yep.
Right? You do your cash flow projections. Ours were off.
Yeah, no, but it's good. Like we've got some good sponsors coming on. We haven't announced them yet. Like we've got such a great team working on the conference. So
sounds like you're having a much easier process than we did.
You know what I did though? Like I actually I think this is true with everything, but like in terms of sponsorships, I sought out one of the best people for sponsorships, and I learned what they do. And then in terms of event planning, for venues, I just sought out people who had already done it, and it was stupid of me not to actually call you up and be like, hey, let's talk. But I just am modeling what other people have done, or taking, and I think everybody's gone to conferences before where they're like, oh, well, I was kind of disappointed for this reason.
Mm-hmm.
So, and that's one of the approaches I took with this. I have things I've been disappointed with in the past. Mm-hmm. Not at yours. Your event was awesome.
Thank you.
But at other events. And it's like, okay, well, how can we make this even better? Right? So.
Yeah. I'll share some stories after.
Yeah, I'm sure there's some good ones.
Yeah. No, it was it's quite an experience. Like I've shared on this show before. I don't know if I've shared with you. If I knew what it was going into it to put on the conference, I wouldn't have done it.
No, but that's the thing with everything. Like, you can say that about doing your first apartment deal or your first house flip. Like, you're better off not. It's like having a kid, right? Having a kid can be stressful.
Mm-hmm.
Yeah, it's also the best thing ever. But
kids are good.
Yeah, but actually, one of the things I do want to do with my son Callan is get a picture with him and Kevin before Kevin speaks. So I think that would be cool.
Cool.
Yeah. We'll bring Callan on stage.
Awesome. Yeah, I was lucky to have Grant run into my kids in the middle of everyone.
Yeah. Just they don't appreciate it now, but down the road, I think that's some cool stuff that they can look back on.
Awesome. And what's the date?
May 14th and 15th, 2022. So everybody's going to have a vaccine at that point. Will be open. And actually, one of the questions some people email in, hey Seth, what happens if we have Corona version 6 happening in 2022? That's very unlikely, but the venue is large enough. We do have contingencies. We are putting on the best live event we can. It's happening no matter what. So,
no, I'm quite confident that the vaccine will be fine.
Yeah,
talking about May next year.
Yeah, and I with real estate, I'm talking with guys in Florida and Texas all the time, and they're back together. They're back to normal. Mm-hmm. So that's good.
So we wish them well.
Yeah.
Awesome. Seth, any other coordinates you want to share? What else do you shared your YouTube? Share your YouTube again.
Yeah. So YouTube, youtube.com/Seth Ferguson. I think we just cracked 1,300 subscribers, so we're growing every month. So thanks for the support with that. And then the podcast, Real Wealth Through Real Estate, you can find that on iTunes, everywhere else you find your podcasts.
And then what's the name of your Coachico show?
Oh, it's called Real Estate Simplified. So if you live in Ontario, you can pull it up on demand on Coachico.
Fantastic. Okay.
Yeah.
So I remember I asked you that question. You didn't have to answer right away. So what do you think the government wants to invest in?
Real estate.
Yeah.
Real estate.
Based on the way taxes are, like that's what led me to real estate, because the taxes are heavily favorable for the real estate investor.
For sure. And
Just don't talk about it, but yeah.
No, and once you factor in cost segregation and depreciation, it just like puts on steroids.
Mm-hmm.
So, but yeah,
Just don't listen to CMHC.
no, yeah.
Let's cut it off there.
Yeah.
Seth, thanks for doing this. Amazing stuff that you're up to. And folks, just know, like, Seth doesn't give me anything for this. I'm just fascinated by what he's up to.
Yeah, no, thanks for having me on. Like, I love this Joe Rogan setup. You've got your own Jamie in the back now to pull things up.
Yeah.
So, yeah.
Oh, yeah. So, yeah, we've had some audio issues in the past, so we're just trying to take it to another level.
Nice.
So we can, people will listen.
Nice.
We can share some real advice on how people can get ahead in life.
Yep. That's
Awesome.
what it's all about.
All right. Thanks again, Seth.
Thank you.